In this video, I'm going to discuss one of the important areas of internal auditing, which is financial audit, with special focus on transaction cycles of revenue and receivables. Guys, we all know that from internal audit point of view, the financial audit tests the integrity and reliability of reported financial information and also determines to what degree the organization resources have been safeguarded and protected. Internal auditing relating to financial audit can be done in many areas, whether it be receivables, payables, payrolls, taxation, inventory, so on and so forth. But usually it is performed in connection with a transaction cycle. So what we need to look at is the revenues are legitimate, the revenues belong to the company, the transaction did occur, and we are looking at the completeness of the transaction, the various documentary evidences, so on and so forth. So if you're an internal auditor and you're looking at audit of receivables and revenues, the very first thing you need to start off is from the sales order. The sales order is a documentary evidence that the customer placed an order. It has the details and descriptions of the goods or services which are to be provided. So sales order is also like the purchase order for the customer. So customer sends a purchase order for us. If yes, at the selling end, it's a sales order for us. If the company shows that the sales order is there, obviously we have to look at the subsequent stage. Okay, if there was a sales order, were the goods actually delivered to the customers? Were the goods shipped? Now, when I say shipping, that does not mean that it has to go through, a sea carrier. We are talking about goods being delivered. So if it is an overseas shipment, then obviously you will have bill of lading, which has a document, which is an important document, which has all the details showing that the goods have been handed over to the carrier. If it's an internal shipment, you may have some courier documentation showing that the goods were actually delivered to the customer. The goods were actually dispatched from the company. So it's not a fictitious sales. All right, if we have the sales order that is there, we have the shipping document, including bill of lading or courier's documentation. That's okay. Next thing we are looking at is the sales invoice. If the sales order was received from the customer, the goods were dispatched, did we created a sales invoice? Did we initiated a sales invoice? A sales invoice is a bill which is initiated for payments. Obviously, we're delivering goods, customer has to pay. So if there is a sales order, there has to be a shipping document, dispatch document, and a sales invoice also. And all these documents should have similar information which complements each other. So if the sales invoice is been issued to the customer, that means the customer will be paying as per company's policy. It could be cash on delivery, it could be some credit terms, maybe the customer will pay after 30 days, 15 days, 45 days, depending on the company's policy. So now we need to track whether there is a remittance advice from the customer. Most of the time what we do is we request the customer, once they have sent the payment, whether it is through a courier or through a bank transfer, send us a remittance advice. So we need to track the remittance advice which the customer must have sent to us, stating that payment has been made and maybe it's in transit. Another thing to look at is the list of remittances. Obviously, a company may have so many customers and there is a strong possibility that you are selling the same customer so many times in a month or in an accounting period. So you need to have a list of remittances which the customer has sent to you. Sooner or later, we'll start receiving the checks. There has to be a list prepared, which we call list of remittances. It is a list of all the checks received in a given day, and it is prepared by the person who opens the mail. Another important area for an internal auditor while auditing transaction cycle for revenues is to look at whether the checks received have been deposited into the bank the same day, ideally the same day. So in that, we need to have deposit slips. Deposit slips ensuring that the checks which were received has been deposited into the bank. Once they are deposited into the bank, we have to create a listing of checks. all the checks which have been deposited into the bank. The deposit slip is a record by the bank that shows that the checks have been deposited. We also have to have a record of the checks which have been deposited, the company's own records. We also need to look at these two important things, receiving reports and credit memos, and they go hand in hand. Receiving report is basically a report for goods being returned by the customers. Obviously, if you're making sales, some of the goods may be returned by the customers, so they have to be properly recorded in the receiving reports. And once they are recorded, we have to issue a credit note. Credit note is a documentary evidence showing that the customer need not pay for the goods which have been returned. As an internal auditor, you have to look at the details of the receiving reports and then match it with the credit memos issued to make sure that there is no discrepancies. So in a nutshell, if you are doing financial audit for a transaction cycle of revenue and receivable, you need to ensure that these are the documents which should be there. They exist, they are in sequential order, obviously in chronological order, date-wise, so on and so forth. At the same time, you also need to ensure the people who have been given important roles in the entire revenue and cash collection cycle. So the very first important role is the mail. There has to be a person who's in charge of opening mails. Obviously, mails are important because most of the customers are sending their money by check in the mail. The person who's opening the mail need to ensure that the checks received first have to be screened, because it could be you're receiving a check by mistake, it does not belong to the company. So the checks received has to be screened whether they belong to the company, has to be recorded properly by the person who's opening the mail, and it has to be stamped for bank deposit only or accounts pay only, and immediately after listing the checks should be handed over to the person who's going to deposit it into the bank, because delaying the checks to be deposited into the bank is not in any case in the favor of the company, and there is an opportunity cost. So at this point, I would like to emphasize on the role of an internal auditor in suggesting improvements in the operations. So if you observe that the checks have been received on day 1 and has been handed over to the person who's going to deposit them on day 2 or day 3, this time period has to be minimized, and ideally it has to be on the same day. The person who's receiving the check is different from the person who is depositing the check, and this segregation of duty is very important. The person who is depositing the check has to ensure that he deposits the checks, collects all the deposit slips, make a listing of checks have been deposited on a daily basis. Obviously, when we are talking about revenues, we are talking about receivables. When we are talking about receivable, there are chances that certain receivables have to be written off as bad. But obviously, these decisions are not taken by junior level management. You got to involve the treasurer or a high level of management with a proper rationale if they are to write off any particular amount. That cannot be done by the same person who's receiving the check and depositing the bank and decides to write off because the customer is not paying. No, this has to be done by a high level of management and requires appropriate level of authorization. Obviously, there are companies where customers would like to pay in cash. So a person who's receiving the check should be a different person, and people who are dealing with cash should be separate individuals. So if cash is received on a daily basis, it has to be appropriately recorded. Obviously, there should be more than one person involved in receiving the cash, so that the other person is also watching how much money is coming in or not. And a report should be made on a daily basis, and the senior management should be updated on the amount of cash received every day, so that there is less and less chances of any misuse of cash, embezzlement or discrepancy. So guys, these were some of the tips and important things we need to know if we are auditing transaction cycles for revenue and receivables. The list of documents you need to see, you need to have these documents. You know, there is a famous word we use, whether it be external or internal audit, we are talking about sufficient appropriate audit evidence. So most of the evidences which we collect should be authentic and genuine enough. At one place we are looking at the source documents of transaction. At the same time, we are looking at people who are involved in these processes. There has to be appropriate segregation of duty so that chances of frauds are minimized. So guys, if you have any question relating to financial audit, specifically transaction audit for revenue and receivables, please leave a comment. I will respond to you as usual. If you have not yet subscribed to my channel, please subscribe to my channel. Press the bell notification button so that you get my videos on a timely basis. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time.